Yes, please do. So, once again, good morning and welcome to our weekly broadcast, Thursday, 10 a.m. Although it's not 10 a.m. for John. So, my name is Dal Wright. I'm the investor portfolio manager for Leo Crowdfunding, and we also have John from Property Fortress. John, you want to give us a quick introduction there, please?
Very good. John Corey, Property Fortress, long-term landlord, property investor, and co-host of this weekly broadcast.
Thank you, John. So our regular topics. So yeah, just as John mentioned moments ago, this is recorded, and you'll be able to access this through our YouTube channel. So do subscribe. The details will be at the end of this broadcast. So we have a quick overview of markets. And then we'll go through some topics with John, and then project focus, and also share educational tips once we do that as well. If you have got any questions, which we will definitely encourage, feel free to put them on our Q&A chat. Not the chat itself, but just the Q&A question chat, and then we can go through those questions throughout the broadcast. Right, so let's kick things off. So our weekly market update, interesting piece here. Some information from RICS. So the cost and availability of building materials continue to be viewed as major challenges. Construction output indicates that it is around 6% up on a year ago, and 2.5 above pre-pandemic levels. I did read somewhere that the construction out in forecasted in 2023, it's predicted that it's going to be dropping at 3.9%. But there we go. That's a forecast. And then, of course, shortage of labour, particularly in self-employment sectors. What's your view on this, John?
Well, it's interesting how it's 6% up from a year ago, but it's 2.5 from pre-pandemic. So in a sense, I guess a year ago, prices had gone up 6%, but I take it that prices must have dropped from before the pandemic. So price went down, as probably the graph is trying to show us. Then we have, lack of work happening or reduction in work, supplies in surplus. Then we end up with supply chain problems, and we start to see prices going up dramatically. And then as the supply chain smooths out and gets sorted and people get used to what they can expect, then we're normalizing. So this turbulence, this up and down, this bouncing around is painful for those that are trying to place an order at the wrong point in the curve. And something that if you're a passive investor, we'll get this to more later, but as a passive investor, you have to think about when you're investing, does the entity, the business you're investing in, understand how to manage their supply chain, and have they priced in or put in a buffer or create a contingency for turbulence in the material cost?
Yeah, completely. I was speaking to one of our developers, and although easier said than done. Buy, retain stock. If you've got multiple projects on, seems to be working good for him. But at the same time, he's expecting, many delivery shortages, delays. So of course, again, stopping the project from kind of excelling to where and working within that time frame. So a lot to consider there. And of course, we've got unexpected events, such as, I don't know, China now going into a COVID lockdown. So again, we possibly could see a bottleneck again from what we've seen in the last kind of 18 months collectively. So as the markets reopen, we tend to see something else possibly coming about. So a bit of a crystal ball, that's for sure. Right, so just wanted to highlight one of our projects that we've got currently going on. So it's live for investment. It's from Mark Aviva. So those of you who know Mark, he's a barrister. He's done a few of these types of projects. planning. I'm not sure if he's done a planning one, but he's certainly been in the property industry for quite some time. This particular project, it's a 50% return on investment, which is estimated over a 9-month period. That's 42 apartments, and I believe it's 4 townhouses in Surrey. So great little project. There's a CGI video of the project itself by the YouTube Leo channel, or you can just simply go on to the main page of the project on the platform, and you'll be able to view details of the project and watch the video. So currently it stands at, and this is dated, so it's 111,000 raised with 38 investors. So it has been extended. Just the interest that we've got currently going on due to Christmas, etc., and possible material changes as well for the good. So we've extended the project slightly just to see how that uncovers, really. Have you had a chance to look at this one, John?
So I haven't looked through this document. I've spoken to Mark more than once over some time now, and he was a guest on this recording about, I think, 1 or 2 sessions ago. So I have invested in other planning uplift projects. I'm somewhat used to the mechanics and the process and the types of risks that you're taking when you make these sorts of investments. What I did find interesting, and this is in a discussion I had privately with another investor who he's a planning consultant, actually. He was impressed at the project when it comes to how it's land assembly of different owners' interests in to bring this together. These things are hard work, and he was impressed that Mark was able to get the owners to line up so that then this joint application could be submitted.
Yeah, indeed. And of course, if you would like any further information on there or have any questions, you'll have my details at the end of this broadcast, so you can reach out to me directly.
I do suggest on planning uplift projects, if you don't know what they are, this is a great opportunity to read the document, go through the information, get your head around what does the strategy mean, what are the risks, what are the opportunities. It doesn't mean you have to invest, but I do encourage people to use these things as opportunities to learn and to see how other people are approaching projects like this.
Thank you, John. So David, of course, our CEO, is not here today, but he is on the road. He's actually currently in Bristol in the UK, but he's also recording for a special podcast covering for next year. So please do watch out for that. I believe, John, you're a regular contributor on those podcasts as well. So I'm sure you're looking forward to it.
That's the plan. David's he's launching his podcast channel, and he wants to get out there and talk to people about what they're doing and go in a bit more in depth and make it more of a sort of conversation where people can listen in. So we'll see who he has on his interviews, and occasionally you'll hear from me.
Great stuff. Looking forward to that. And then our main topic for this week, so FCA regulations from an investor perspective. So John, obviously, you know a lot about this in this space, and this is kind of the main kind of topic of the week. So, I mean, in your view, John, I guess in a summary, what is a passive investor?
So there's a real assumption behind this. So the FCA, you could argue, is to protect the consumers and to help facilitate an orderly marketplace for financial transactions. And in particular, there's a presumption that the average man in the street, lady in the street, person in the street is unable to understand complicated, sophisticated, weird, and wonderful investment opportunities. So the FCA wants information that's shared with retail investors to be clear, to be fair, to be transparent, to be balanced in terms of risks versus rewards and things like that. So a passive investor is someone who's not part of the management team. So if I was to JV with you, Dal, and we were going to do a project and we're sharing the workload, and maybe you know more about architecture and I know more about sort of budgets or accountancy type things. We can divide up the work to our specialty, but we're collaborating on the management. And then in the case, say David he's off flying around and he doesn't have time to be part of the management, but he wants part of the deal. So he decides to put in some money and says to the two of us to get on with it. So he would be a passive investor. We would be the active management team people. So in that case, there's two of us and one passive investor. So a passive investor generally is hands off. Some people might say sleeping investor. It's the person who's not in charge of things. They probably aren't providing any PGs, personal guarantees. They're not on title. They may have made their investment as a loan, or they may have made their investment as equity into the project shares of the deal, but they're not in charge and they're along for the ride. The analogy I like to use is if you and I were the bus drivers and we're rotating driving the bus, they're the passengers in the back taking a snooze waiting for us to get there.
Yeah, I like the way you put that, John. That's definitely nice and clear. I mean, I guess, why invest through property crowdfunding in your view then? What would be the kind of the main purpose of doing it through a regulated platform such as ours?
Well, a couple of things about that. So as a passive investor, I've sort of got my feet up. Maybe I got a glass of wine or a bottle of water, or whatever. Or maybe I'm watching the telly and all the rest of it. So I don't really have my eyes on the project. I'm depending on someone else. So I'm sort of outsourcing the management. And I want to be able to see what's available. And one great thing, if you're doing it through our platform, is in a sense, the deals are on the platform and I get to look at my leisure, subject to when a deal is available, and I can peruse the information. Now, when it's on a regulated platform, which is how we're using the phrase here, crowdfunding, this means in the UK, the FCA sets the boundary conditions. They set the rules and regs for what a platform needs to do and what offers on that platform need to look like at some high level way. And again, it's back to, is it fair? Is it easy enough for people to understand? Is all the information balanced and things like that? So by being on the platform, I can assume, not always a good thing, but I can assume that I don't have to hunt around a lot. I can wait till a deal comes up on the platform. I can then peruse the information. It's been through some sort of sign-off process, so it's appropriate for me to read. Doesn't mean it's right for me to invest. It's just there. It's reasonably presented. The authorization process, the approval process to get a raise onto a platform does not say it's a good or bad deal. It does not say it's suitable for me as a person, but it is saying that the information is reasonable for me to evaluate as a retail investor or a high net worth investor, whatever my status is. Now, the other thing about having it on the platform is other people are looking at it, other people are checking it out, other people might be using the forum to post questions. So there are things that maybe I don't understand. I can post a question. Other people might understand it better and be able to comment, or they'll raise other questions that I never even thought of. So it's an opportunity to, in a sense, share the vetting at some level.
Yeah, no, John, I totally agree. I think that's a very good point that you make. And I think you did mention that previously. It's nice to get those questions on the forum, because even myself as an investor portfolio manager, there are questions that I think, hang on a minute, I just need clarity on this. That's a different way of thinking about it. So, hence why we encourage any of the projects, ask questions as much as you possibly can. It allows everyone collectively to as you mentioned, vet the project and get a sense of kind of the questions that are out there, and a sense of questions that should be being asked as well. So totally take that on board. And I guess it's an obvious question, but why does regulations matter to passive investors?
Regulations aren't necessarily good or bad in isolation. The process evolves over time. We're going to talk about how there's new regulations. So by having some ground rules, by having some boundary conditions, it causes people to get used to what to look for, what information has to be shared, that there's, in a sense, a little bit of the collective wisdom of the best way to do this in the past is the following. Therefore, they created rules for that. So now everybody should do it the same way. So it helps normalize and helps sort of create an easier environment for people to get their head around. You understand what the rules of the road are, so that it's sort of like driving on the road. If everybody did whatever they felt like, it's a bit chaotic. If the rules of the road are clear and people tend to follow the rules and they tend to operate to the rules, then it's a more predictable flow of traffic. So the regulations are there to help people make their own decisions. So I am responsible for what I decide. I am responsible for what I invest. If I win or lose, if I lose my money, if I make bad decisions, that's on me. The regulations, though, at least provide a degree of consistency for what is shared, how it's shared, the steps that maybe we go through when it comes to signing off or putting in the money or moving forward, things like that. So it's creating a good environment, or a healthy environment, or a robust environment in which people who have opportunities can meet people who have cash.
Yeah, no, thank you, John. Completely agree. So, of course, the FCA, UK, they set out financial policies changes to strengthen financial promotions. I think we've seen quite a few changes in the last 12 months from memory. I think there's been 2 or 3 possible changes, and the most recent would be the PS 22-10. It's a 205-page document. So if you have got some time during Christmas and you find yourself bored, I'm sure that's not going to be the case. Feel free to read up on that, but I'll put the link via the chat. So what do passive investors need to know, I guess, with the new policy statement essentially geared around that?
So this came out in 2020, 2022 rather, but it's really emphasizing, and the foundation is policy statement 20-15, I think it is, which is from 2020. So fundamentally what they're saying is property development projects are high risk, particularly where you're adding value and you're a passive investor. There are all kinds of reasons why the project might go poorly, and it has nothing to do with your initial decision. So they put in things like speed bumps. They put in things like risk warnings. There's been a little bit too much social media about, savings rates are low, beat the bank, get a better interest rate. None of that is legal. Those are all illegal promotions. The FCA now is making it even clearer that this is higher risk than a savings account. Savings accounts come with guarantees when you put your money into a regulated bank. These are not that. This is very much, you could lose 100% of your investment. So one of the risk warnings that's now required says that this is essentially, in my words, paraphrasing, and the FCA does provide exact words, but paraphrasing, this is not a savings account. You can lose 100% of your investment. And that has happened. This is not just theory. People have lost 100% of what they've invested. So the point of all this is to get the passive investors to slow down a little. One of the things that people as a passive investor do is they go onto a website, they look at the deals, and sometimes they feel competitive pressure to get in, that, oh, my money's not doing anything and my friends are all investing, so I need to invest. I need to pull my finger out, yada, yada, yada. And the FCA has commissioned studies that show that people feel social pressure. People feel the need to sort of push buttons like some of these online apps, the gamification of investing. And that has caused people to make bad decisions where they're sort of rushing in to do things. And what the FCA is trying to do is what I call a speed bump. The positive friction, I think, is the term they use in the document, where literally we want people to pause. We want people to take 2 minutes and read the extra risk warnings to really sort of slow down a little, maybe have a cooling off period. Oh, I'm interested. Well, now you have to wait 24 hours so that you don't make a rushed decision. There are great opportunities, but not every opportunity is great for you. And at the same time, there may be things that are great for one person, but you don't even understand what it's saying. My suggestion is, when you don't understand something, just pass. or read all the documents, be a phantom investor, pretend that you are going to invest and try to understand it and ask questions in the forum. But it's your money. If you lose this money, how hard is it going to be to replace it? It could be a big struggle. So do not take this lightly. You want to take as much time as you need. And if that means you can't invest in a deal because you won't be able to figure it out before it closes, fine. There'll be another deal. This is like buses. There's always another one coming along. So don't be in a rush. Now, policy statement 2210, if you want to read it, it's technically maybe as long as we've just heard from Dal. The core of the document, though, is not that long. And it's written in what I would say is English. It's a little arcane some of the time because it's dealing with regulations. They're referring to things that are maybe not what you're used to seeing day to day, but this is definitely readable. I do encourage people to look at these documents. If you want to raise questions of myself, Adele, or anyone else, perfectly fine. Do get in touch. We can have a chat about it. I think it's healthy when investors discuss regulations. So passive investing is good for those that don't have time. Passive investing is good for those that don't have specific expertise. I'm not a planning consultant. I like the opportunity to invest in planning uplift, but I like it when other people who have planning expertise are in charge of it. So I'd rather be a passive investor because I wouldn't know how to do it myself. When I travel, I don't fly the plane. I sit in the back. I expect the pilot to know what they're doing. And I evaluate the likelihood that we're going to get there based on who the airline is. Are they correctly staffed? Does the team make sense? So that's what you should be thinking about here. These are not necessarily projects that you would do because you're a passive investor in these projects, but does the team make sense? Do they have the right background? What is their track record? And then when you evaluate any of these deals, definitely look at what could go wrong. The pitch is generally going to be about what could go right. You need to think about, well, what could go wrong? And in a couple investments I've done where I'm not completely certain. So then it's like, well, what am I prepared to lose? I know one investment I'm in where I wanted to learn something. It was worth it to me to put in £100 to learn it. If I lose the £100, that would be the price of a course. I was happy with that transaction. I was happy with that trade-off of value. That's for me. That's my decision. That's not your decision. So look at these from a lot of different ways. And possibly if you had £1,000, invest in 10 deals, not one deal. Put £100 in 10 deals, learn different things, spread your risk across different teams, spread your risk against different geographies, different project types, teams, as I said, so that you get some of that diversification, but you also speed up your learning process. You'll see 10 different shareholder agreements. You'll see 10 different pitch documents. You'll probably look at other deals that you don't even invest in. So you'll read more than 10. The key here is you have to read.
Yeah, no, well put, John. Thank you for that. I mean, I would like to think, and I'm sure you would agree, John, that Leo does bring this to the table in terms of, ensuring that the FCA guidelines are met, although being authorized and regulated through sharing. If you were to go onto our platform and webpage now, you would see the new risk warnings. So we are always current, up to date. We would like to put this forefront to our investors. We don't shy away from these updates, whereas, and I can't speak for any of the other platforms, but this is definitely something that we would definitely keep on doing to ensure that we are on top of things.
Well, one of the keys to play off of that 2210 has a rollout schedule, and some of the changes took place or became effective December 1st. And I noticed about a week before that, the Leo site started having new risk warnings and started having some changes. And having read the original document, not the 200 pagers, I read the main section, I could spot those changes and saying, okay, yeah, that's one of the new changes that had to be made. The take 2 minutes to find out more is an example of that speed bump, that sort of positive friction where why don't you pause for a minute, understand the risks some more, dive into a little bit deeper. So that was all quite good when it comes to Leo staying up to date. That's one of the advantages of regulated platforms is someone else is responsible, someone else is spending the time and the money to stay on top of the regulations and update themselves and update the platform so everybody benefits.
Yeah, thank you. Thank you, John. Well, hopefully I can. So next week would be the year summary for Leo crowdfunding. So we'll have all of us on there. John, obviously, being our regular host on the web on the broadcast. And then we'll have the team on there as well. And this is very much to summarize what's been going on in the past, current projects, previous projects, what's been going well, what's been going not so well. So general kind of 12-month review, if you like, and it enables investors and developers to ask questions about specifics. So it'd be nice to kind of get. I think John, last year when we did this, we had I think the most viewed from the year, which was good to see. So all of our regular investors and anyone kind of generally who tunes in did. And also it will be recorded. All of our content is on YouTube. We've got hundreds of videos. So do please subscribe, and you'll be able to watch through any of the content, loads of guest speakers and then everything else around it. So thank you for that. And here are our details. So you've got David's email, our website, and then, of course, they've got the support inbox as well, should you have any questions about anything that we've discussed today or previous, or any of the projects or around how equity crowdfunding works as well. John, do you want to just give a couple of final words? And
yeah, I mean, one thing, regulation is good because it standardizes the rules by which everybody operates, and they can focus on the deals and less on sort of how they present it. One of the keys here, though, folks, is passive investing in any of these deals is there is no safety net other than your ability to read and your ability to ask other investors what they think of things. There's no compensation fund. There's no sort of you'll be bailed out. Your investment is fully at risk and rewards. If there was no risk, there'd be no reward. So if you're looking at an eye-watering rate of return, there must be some eye-watering risk involved.
Yeah, absolutely. Well, thank you so much, John, for your time, and thank you for everyone who's attended. And we will hopefully see you next week. Take care. Bye bye.